What is up, everybody? I'm Novo coming at you with another one. I've been getting a few private messages asking questions about the pi indicator algorithm, and I thought I would do a video in great detail describing both the pi indicator and it's a scale fractal of the 350-day average. So without further ado, let's get into the meat and potatoes of it. So as you can see, we've got the orange line here, and we've got the green or the lime line here. And whenever the orange crosses the green, it signals a top. Obviously, we couldn't signal this top because we don't have enough data behind us to predict that. Had we had more data, we probably would have seen that. So we had a cross here. It predicted the top, and if we zoom in, it's within 3 days, they say. So this would have signaled an exit right here. 1, 2, 3 days. We can say 4 because of this red candle, but that was a dump. It was opening here and then down. I would call that a massive win. And here the signal came a little bit later. So there was a dump and then a bounce, and the top, I mean, I'm not gonna balk at that. So the top, we can argue, is right here, and that's 1, 2, 3. Well, fourth day again. As we go over to the right, same thing here. Let's zoom out, zoom in a little bit more. This is on log scale to keep things a little bit more horizontal. And the top was literally the day before, and the green candle. So technically, had you opened up, that would have been the exact top, and then the sell-off came down. Is that everybody? 2018, right? Then we had this massive drop. There is the false rally indicating the start of the bull run. And now we are very close to the orange crossing over the green again. So what do these two lines represent? Sorry, I wanted to go here. So the two lines represent the first data points we're entering in is the 350-day simple moving average and the 111-day simple moving average. And if you take 350 days divided by 111, I believe that's the closest you can get to pi, 3.14. But these two SMAs are not the two lines that are showing on excuse me, on the chart, because if that were the case, the 111 would be above the 350 all the time. Instead, what it is back to the chart. How do I do this? Park this down here. We have the 350 day underneath, but it's actually 350 times 2. So it's 350 days times the price times 2. So that's why this escalates at a faster rate than the 111 day. And then by that cross, that volatility forces the longer average up quicker and then causes that cross, signifying the top as per pi, or 3.14. The other beauty about another indicator that I've been mashing in together, so I've taken code from different indicators and I've been mashing them up. So we've got what we call simple moving average multipliers. And in this case, the 350 times 3, the 350 times 5, the 350 times 8. Are you recognizing the sequence? 350 times 13, 350 times 21, and the golden ratio at 1.618. That should have been the giveaway right there. Yeah, it's the Fibonacci sequence. So 350 times 3. I've got these all as gray, but I've been messing around with it. We'll go back up again. So these indicated tops. We have a potential top coming up, but we have an argument coming, which is happening presently. And let me show you what I'm talking about. So just to recap, the orange line is not the 350-day average. It is the 350-day average price times 2. So it's twice as high as it should be. And if we show what the 350-day looks like, you can see, I'll change that to pink. Okay. So what do we see? We see the average, 350-day average, which is going to climb up with price. But we see the multiplier of 2 making the average much, much steeper, catching up to the 111, right? So in a bull market, averages should remain above each other if they are a smaller average. And that's what's happening with the 111, which is green. And this is the 350, which is pink, and it stays below as long as we're in a bull market. When we go bearish and there's a super sell-off, if the two moving averages are close enough to each other, then we would see a death cross. In this case, we don't see death crosses. We see a tunnel through the air. Read up on Gannon, you'll know what I'm talking about. So this is indicative of multiplying it by 2. Okay, so now I'm just going to go back to make this look simpler. I'm going to turn that off. And these are the multipliers that I was referring to in the past. And we're going to go back to the beginning. Right here. So I turned on the 21 because that one was actually pointing toward a peak. Let me delete this for a second. I'm going to try and keep this video as short as possible and as fun-packed as possible. So we could argue that that's kind of in line there, right? So that is the 21 calling that peak. Now, if we go back to the Fibonacci sequence and we go down to 13, so these are orders of magnitude of the 350. So that would be 350 times 21, right? Okay, so, oops, sorry. So now we're going at the 13. So the 21 called that. And look what we have here. It's like surgical, wouldn't you say? Look at that intersection right here. We can see that the next multiplier under called that one. And this starts to corroborate with a rule, and I don't know what the rule is called, but there's it's a rule of adoption, essentially, right? So things become more parabolic, more volatile with less adoption or early adoption. Once everyone has adopted, then the change or the fluctuation will be much, much less. And it basically explains the Forex market. That's why they deal in pips, because no one's going to trade a 1 cent trade, right? They're dealing in pips. The volatility is so minuscule that you have to deal in higher numbers or higher units in order to make a profit. Where at the beginning, Bitcoin, you didn't need that many to make profits because it was so volatile. Excuse me. So as you go down in the multipliers, the volatility drops down. The 30% drops start to dissipate. Then the average is 20, and then the average is 10, and then the average is 5, and then the average is 1, and then we go into pips. So that's just a brief synopsis of this. So we've got the 21 that predicted this one. The 13 predicted the next one. Did the 8 predict the next one? Yes, it did. Wouldn't you say that the argument was resistance right there? And the top essentially was right there, right? So if that's the case, should the next top be predicted in time and in price? That would be the SMA 5 for Bitcoin. And as we keep going right into the future, there's your bull run. And it's mind boggling. So the pi indicator predicted the top. We even got a warning flash from the multiplier predicting the top. Is your mind blown yet? Let's go to the 3. Going down, we missed it. It must be later. And sure enough, here we are right now. Now we're at a precipice because although we're flashing a top or a turn or a resistance point, we have not seen a top in the pi indicator. So that's telling me that we may be riding this one out for a bit until we see that cross. And then when we see that cross, we will be within 3 days of the top if this indicator is correct. And by law of averages, have we been correct? I would say yes. In fact, based on had this been working earlier and the tops, we would have been 4 for 4. Are we going to be 5 for 5? That's what I'm wondering. So a quick look at the code again. It's available everywhere. If you want this code, I could probably publish it. But this is not my code. This is just based on math that I've seen out on the internet. There's a website. If you Google Peter, there he is. Philip Swift. If you Google Philip Swift and the golden ratio multiplier, there's an article there that describes everything that we're talking about here. And honestly, this is sacred math stuff that I turn inside out for this stuff. I love it. Anyway, this is your plot functions here. So this is what puts it on the board, right? This is based on the data that we're going to be multiplying off of that. And then I added some EMAs to the 350, 200, 150, and 20. So if you go back to the indicator, so down the rabbit hole, that's these guys here. Like if I wanted to do the price close and I didn't want to see candles, if I want to see the 200, you can see the interaction of the 200 and the 350. If I wanted to zoom in and, only watch the, let's turn that off. I only wanted to watch the interaction of the 20 and the 50. You know how I love the support lines of the 20 and the 50. Technically, I like the 21 and the 49 because those are replications of the number 7. And by zooming in, we get multiple arguments, right? So what was the argument presently? Was we're waiting for a cross on the pi cycle indicator. We've got the 20 showing support. We've got the resistance of the, what is this, the 3, and we've got the 50. So all of these are all pointed up, and somewhere in space and time, or price and time, there is going to be a major change in trend. With regards to the hoopla that's out there, everyone's talking 50,000, 40,000. We already hit 42. I was thinking 36,000, and we're kind of hovering around there right now. That being said, I'm almost afraid to say that BTC may actually pop up to about 90 grand before all is said and done. I just put a little prediction. In fact, I think it's more like maybe it's more about here, more in March. Anyways, this is basically as good an example as I could um, show you with regards to explaining what all these lines mean. So just to recap, let me turn off these moving averages to prevent confusion. And I urge you guys to get into the coding of this stuff. Understand what these lines mean. Why are you predicting price off of it if you don't understand what the line actually means? Get in there. It's not just smoke and mirrors. There's math behind this. Okay, so just to recap, these are all multiples of the price of the 350 day simple average, and it's based on the multiplier that you assign this, right? So this would be the three. I just went blank. Let me show you on the indicator itself. So the this one right here is the 3, the next one is the 5, the next one is Fibonacci 8, and then 13, 21, etc. I don't see us going back up to that. I mean, it's possible, but I think it's highly unlikely. I think what we're doing is we're playing with these 3 lines here to indicate. Right now we're flashing a warning because we're sitting right on it. We sat on it before. Where are we here? Let's see how long we stayed on that line. Time. So we were just under it here. We crossed here and we stayed onto it for 12 days, 12 bars, 12 bars, 12 days. And where are we right now? Let me just bring that back over here. And I mean, technically, we could say that we wicked right here. And we're waiting to see if we close at 13 bars. So what does that mean moving forward? It could be that the volatility is getting less than this number and we're starting to fine tune. It could be that we're going to zigzag on this. I can see the uphill pennant, the rising price as it consolidates, getting ready to go again. We need to close above that to continue following this line up. It could be that we're going to be, if it was 12 days, this could be some Fibonacci multiple of 12 a little further into the future. Maybe it's even, I don't know, double that, 24, etc. And we're waiting for these 2 lines to finally cross. And that all should be coming up closely, and then we'll see a pullback, and then we'll see that Elliott wave, that 3-wave regression as we go down, find base, and then continue on up again, because there are no stock splits. The price is the price based on availability, supply and demand. And right now, we're heading into less supply every time. Okay, that's it. We're at 19 minutes. I hope that describes everything for you. Play with the numbers, plug it in, learn how to do the indicators yourself. You don't need to pay for stuff like this. I love the fact that guys actually put stuff like this out there for free. Those guys are definitely on my good boy list. Charging for an indicator is, I mean, if the indicator makes you money, you don't need to charge for it. That's basically my opinion. Everyone has their own strategy. Me personally, you have to hunt me down to pay me money. I will never email you asking you for money. If you get an email from me asking, it was not me. Anyways, that's it. Trade safe. Get out there and have fun and learn.